At the beginning, one company is usually enough. One product, one bank account, one cap table, one founder decision. But then the business grows. You open another product line, you add a foreign subsidiary, you keep IP in one place, operations in another, and clients in 3 different markets. At that point, the question changes. It is no longer how do I receive dividends? It becomes how do I build a group where money, IP, and control do not become chaos?
A holding company is not usually the company that sells the product, hires every employee, or signs every client contract. It is the ownership layer. It can own shares in operating companies, receive dividends from subsidiaries, hold strategic assets, centralize founder control, simplify investment, and make a future sale or restructuring cleaner. For a founder, the holding company is less about tax tricks and more about architecture. It answers a basic question: where should ownership sit? Cyprus appears in holding structures because several rules can work together. First, qualifying dividend income received by a Cyprus company can be exempt from corporate income tax under participation exemption logic. Second, profits from disposals of corporate titles, such as shares, are generally exempt from Cyprus corporate income tax. Third, Cyprus generally does not levy withholding tax on dividends and interest paid to non-residents, with important exceptions for blacklisted and low-tax jurisdictions. This is why Cyprus is often discussed not only as an operating jurisdiction, but as a group structure jurisdiction. Participation exemption is the reason many founders look at Cyprus once they have subsidiaries. If a Cyprus holding company receives dividends from a subsidiary, those dividends may be exempt from Cyprus tax, subject to anti-avoidance rules. But the word qualifying matters. Foreign dividends can lose the SDC exemption if the paying company is mainly passive investment income and is taxed at a significantly lower level than Cyprus. So the right question is not, are dividends always tax-free? The right question is, do these dividends qualify under the participation exemption rules? The second holding company use case is the exit. If the founder sells shares in one subsidiary, the group does not necessarily need to sell the whole business. A holding structure can make it easier to sell one product line, bring in an investor at the correct level, separate IP from operations, or reinvest proceeds into the next company. Cyprus is relevant here because profits from disposals of corporate titles are generally exempt from Cyprus corporate income tax. For founders thinking about scale or a future acquisition, this can matter more than the annual tax rate.
A holding structure becomes especially useful when the founder has more than one moving part. For example, one company owns a software product, another runs the operating team, another serves a specific market, and the holding company owns the group. This does not mean every founder needs a complicated structure. But if IP, employees, clients, investors, and future sale plans are all mixed into one entity, the company may be simple today and expensive to reorganize tomorrow. The holding company creates a map before the business becomes difficult to untangle.
A Cyprus holding company is not a universal answer. If you have one small service company, no subsidiaries, no IP separation, no outside investors, no exit plan, and no need to move dividends between group entities, then a holding company may simply add costs. More companies mean more accounting, more filings, more bank onboarding, more documentation, and more substance questions. The structure should reduce risk and complexity. If it only adds complexity, it is not planning, it is decoration.
The 2026 Cyprus tax reform did not destroy the holding company logic. The corporate tax rate is now 15%, but qualifying dividend income and share disposal logic are still the reason founders look at Cyprus. What changed is the tolerance for weak structures. A holding company still needs proper records, real directors, bankable documentation, clear ownership, tax logic, and a reason to exist. A holding company without a business purpose is just a tax story waiting to be questioned. So, the real question is not whether Cyprus can be used as a holding jurisdiction. It can. The real question is whether the group actually needs a holding lawyer. For the right founder, Cyprus can help organize dividends, subsidiaries, ownership, share sales, and reinvestment. For the wrong structure, it is just another company to maintain. The best holding company is not the one that looks clever on a chart. It is the one that still makes sense where the business grows, the bank asks questions, the investor starts due diligence, or the buyer reviews the group before an exit. Structure before scale.